The current climate, the real estate market, there's a lot of stress, concern. What do I do? Should I buy? Should I invest? Where? How do I do it? And it's hard enough trying to navigate an increasing market, but in a declining market, when interest rates are changing and the market's changing, and there is just so much noise out in the air, how do you actually navigate it? What do you do? We came up with a list of 10 key considerations. I think we probably could have had a 20-part list if we wanted to, but if you're looking at getting involved in the market right now from a buying perspective or investment perspective, what are some of the things that you should do? What does that look like? How do you get involved? And how do you avoid certain mistakes? We talk all about that and so much more in this podcast episode that I know you're going to love. As always in our podcast, this is presented by Dean, Derek, and I, the partners and owners at Thrive Mortgage Co., where we focus on helping people create wealth in real estate. And if you haven't done so already, make sure to follow us on Instagram at Thrive Mortgage Co., at the YVR REMO Show, and of course, check out our YouTube channel where we have all sorts of great content. We look forward to hearing from you. Feedback is always recommended, and we appreciate it as always. So I hope you love this episode. I hope you love the show. We'll see you on the other side.
What's up, guys? You are listening to the YVR REMO Show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. Okay, so this market has been weird, to say the least. It's been up and absolutely insane, like gas, fuel, and everything else in the fire, and now almost the exact opposite. And this year, to say the least, has been a roller coaster. The last 2 years, the last 3 years for that matter. But that's real estate. And the reality of real estate is that it's always up and down. But there's different strategies and tactics to consider in any market. And more specifically, in a market where there's things changing quickly and the trends are moving, it's extremely important to revisit your strategies and reconsider what your plan is. Because what worked a month ago doesn't work today. And what worked 3 months ago could be completely irrelevant. What worked 6 months ago is in another dimension. So for that reason, we came up with 10 key considerations that we recommend that someone think about when they're looking to purchase or get involved investing in real estate in the market. Now we're, again, in the middle of 2022, but this could basically be something to consider in a lot of markets like this, where we're seeing a slight decline in interest or movement, and perhaps price points and or higher interest rates. So lots happening right now. And if you're listening to this, you're either involved in the real estate industry or you're someone who's looking to purchase or consider purchasing in the next 12 months. Real estate as a whole is still something that we highly recommend considering. And in fact, I've got a great article in front of me talking about recommendations from all sorts of experts to consider real estate as your primary source of investment, even over GICs, especially if you're borrowing to invest. But that being said, it's not right for everyone, and there's some key things to consider. So let's get right into it. We're going to start off with talking about the rates and how to look at your interest rate, because you're borrowing money, as it compares to affordability. Two key considerations specifically when we're talking about interest rates increasing from where they were 12 months ago. Derek, take us away.
Yeah, and just on kind of the basis of this show today, I think this is a really good checklist, like Alex mentioned, that could probably be used in every single market with minor tweaks. I think anyone going into a new purchase really needs to consider a handful of different items before they jump in. And unfortunately, a lot of people don't. So yeah, just starting off, number one, rate compared to affordability. Prime example, we talk about this a lot, first-time buyers going into this market. They're not as scared of a 4.5% rate compared to the person that bought 3 years ago or 2 years ago that saw a 1.5% rate, right? And I think that's because the first-time buyer doesn't have anything to compare it to, so their main focus is affordability, right? Like, what is my mortgage payment? Can I afford it every single month? Obviously, digging into budgeting and principal and interest, all that stuff matters. But I think people need to get away a little bit from looking at the actual interest rate that's on your contract compared to the affordability aspect, especially because I think that we're on the higher end of interest rates right now. I do believe they're going to go a little bit higher, but I don't know that it's going to be dramatic. And knowing that you're getting into a mortgage and a property right now while values are down and rates are up, if it's affordable for you for the next couple of years, you're probably going to be okay, because rates are probably going to go down eventually. Obviously, we don't know the timeline, but I think you really have to kind of take your eyes off the interest rate and look more so at affordability and can I get through this for the next couple of years? Because, like I mentioned, if you can, things will probably only get better as time goes on.
It's important to just remember that most of these mortgages were stress tested as well. So, based on government guidelines, depending on when you got your mortgage, but I would assume probably, certainly I'd say as much as 90% of the clients we work with have been through the stress test. And that means we're qualifying at, rates that are arguably 3% higher at the time when they got that mortgage. So where they're at today, I mean, we're probably in line with something that actually is affordable, especially considering what the stress test makes us go through to achieve that approval.
Yeah, well said, and good points all along. So some actionable recommendations that you can take away when we talk about affordability to that point is to take the time and the energy to build out a cash flow analysis of your current situation, and that doesn't have to be too complex. It's crazy what just looking at your current situation can do to help you prepare for your budget. Now, obviously, there's things that can come up like unexpected expenses. You could be seeing a raise that could impact your affordability from that perspective. But at the end of the day, take the time, take the practice, whether you're in a home right now or whether or not you're looking to buy a home, and start to plug the numbers in. We can provide you with a mortgage calculator to work through those numbers. And we even have a cash flow spreadsheet. So if you're an end user, someone who's looking to buy or invest in real estate and you're trying to get your numbers sorted out, send us a DM on our Instagram and we'll make sure to get you that link so you guys can start using that. So let's talk about number 2, which is timelines for property types. I'll start off really quickly here and just explain what we mean here. So the idea or concept here when we talk about timelines is realistically, how long do you plan to keep this property before you decide to leverage it or sell it or move up or something of that nature? For the last 2 years, it's been actually wild because we see someone who's bought, 2019 to 2020 to 2021, and for 3 years straight, people were seeing 20, 30, 40, 50%, even 100% increases in property values and being able to leverage 1, 2, 3 times. Heck, I leveraged my property multiple times over that time span to buy more real estate. Now we're in a different climate, a different market. We're seeing a declining real estate market. And so the reality is when we help a client purchase a piece of real estate, one of our recommended piece of advice is to have the ability to keep that piece of real estate ideally for no less than 5 years, but specifically 7 to 10 years, because then you're guaranteed, obviously, to build that equity in the form of appreciation. Obviously in this market, the concept or the idea of a quick flip may not make a lot of sense, but obviously there's a little bit more to it. Guys, thoughts on this?
Yeah, I think it's just if you want to take as much risk out of the transaction as possible, that like 3 to 7 year play is kind of key, right? Because that gives a market enough time to circle back and increase, at least come back to initial value if the value does drop over time. And yeah, I mean, if someone called us today and said, I'm going to buy this property and flip it in 8 months, I'd probably say, like, you're taking on quite a bit of risk because the market could be a lot worse. And like, if the market is worse, can you weather that mortgage? Can you hold that property long enough until it makes sense, right? And if someone says no, they could be like, you could lose your shirt on something like that. Another piece is people building homes, right? A lot of people there's builders that build spec homes or just people that buy lots and they hire a builder to build a home and sell it in a year. That's another thing that like you have no idea where the market's going to be. And believe me, we saw people pay a massive premium on lots, massive premium on build costs, and the market has dramatically changed. And some of these people are going to be finishing these houses in 6 months and the value's not going to be there, right? So like you always got to understand your worst case scenario, and timelines are a big part of that. So like the quick flips, the builds, any quick profit, there's a lot of risk in that. But I think that goes without saying, right? Anything that's going to be quick money, there's typically higher risk than something that's going to be a long-term investment.
I think for me, the biggest thing comes from a timeline is always going to be what product are you going to attach to that timeline? And that typically comes down to a variable or a fix, and just understanding the cost to get out of the product. Like if you ultimately need to sell that home, or hey, I'm buying this home and I know I have, a family coming in the next 2 years or so, and who knows what could happen or what your plans are. Ultimately, a lot of people do just buy that, first step home, which could be a condo or a townhome, that's just not going to be suitable for their family in the next 2 years. So knowing how to get out of that product, and when I say product, I mean the mortgage that you have, having a variable in those cases is very important, because you can actually break that term and not have a large penalty like we would have on a fixed rate. mortgage. And then when it comes to the investor side, somebody buying a rental property, timelines are typically, most people go into a rental property transaction with the understanding that this is going to be a long-term investment. I am going to keep this for the long term, but what is the first thing you're going to sell if you get into trouble? It's typically going to be your rental property, not your primary residence. And so just having liquidity to your rental portfolio, because you just don't know what the timeline is, or like just that simple reason, we just may not know what our timeline is. Our intention is long term, but what if it's not? And so again, back to variable, this is a push for variable, but it's really just a push for flexibility.
And that's a key as we talk about strategy, kind of moving forward. And let's touch on that in the next part of the conversation, which is transactionally speaking. So you're looking to buy a piece of real estate, but you're also looking to sell a real estate. An interesting trend that I've been hearing about over the course of the last 3 or 4 weeks is, hey, I want to buy a piece of real estate, but I don't want to sell it until after. Like I want to hold my property and move into it, which has been super interesting. Now, most people don't have the luxury to be able to do that, to carry the two properties at the same time without obviously a higher cost than perhaps they hope. But what about those folks that are looking to sell and then buy in January, February, and March? Well, they would have to go and fight to find a property first, buy it, get it under contract, and then they'd sell, sometimes for more than they even expected. Well, we're in a different world right now where my suggestion for most folks is sell that property first, know exactly what you're working with. And more importantly, time is of the essence. Like we talked to some people and they're going to take 6 weeks, 12 weeks to do renovations and upgrades. Well, by time you do that, your numbers could be off by like $100,000 because of the fact that the market changes so quickly. So I'm certainly on camp, obviously sell first right now. Thoughts, guys?
Yeah, selling first takes the financial risk out of it because like your dollars, right? You know how much money you have, your house is sold. You don't have to worry about that actually happening, which right now is a challenge. A lot of times it doesn't happen, or if someone wants to buy it, it's for a lot less than you expected. So that takes the financial risk out of it. Your only risk in that situation is, what if I now cannot find the house that I want to buy? Right. So like your risk is, where do you go temporarily until you find the right home? Which to me, I mean, everyone's situation is different depending on how many animals and kids you have. But if you can find a short-term rental or stay with family or whatever, like that's not that massive of a risk. It's inconvenient for sure, but it's typically something that people can deal with. Whereas on the flip side, subject to sale has come back. At least we can say that, because that's taken the risk out of purchasing first for the most part. But what we're seeing a lot of is people are finding this home and they fall in love with it. And you just see yourself living there, and then you go and list your house and it doesn't sell. Right. And then everything collapses, and yourself and everyone's done all that. And it turns out to be for nothing, which is really mentally draining on the buyers. Right. Because you do kind of get attached to that property. So there's different ways to look at it. But the subject to sale piece is nice, because previously 4 or 5 months ago, if you were buying first, you had the risk of like, what if the market changes tomorrow? And it did. Like the market changed on a dime in the course of 2 weeks. And there was a lot of people that couldn't sell their houses, and there was private financing and deals falling apart. Like it was a complete mess. So at least we've kind of gotten away from that.
I'm still dealing with that on a few situations where a client did buy before selling, and they're now selling for a lot less, like a considerable amount less than what they expected. And it is going to disrupt their purchase. So for me, like that risk just is nowhere near worth the comparison of living with family or living in a hotel, or like the inconvenience is definitely the best way to put it. I'd rather inconvenient my life than deal with that type of risk. So I couldn't agree more. Like definitely sell. Also, I don't know if this has been classified a buyer's market yet publicly, but to me this is certainly a balanced market, and we're going towards a buyer's market. So you do have the control as a buyer. Like there is a lot more inventory at your disposal. There is going to be a lot more opportunity from that perspective. So again, just another reason to certainly consider selling before buying.
Yeah, what's interesting about that on the last point is, as you mentioned there, from a buyer's perspective, you don't have to be in a mad rush, but there are still markets, to your point, Dean, that are moving. Specifically, entry-level price points, we're still seeing a lot more movement in those particular areas or unique properties. Aside from that, there's a lot of opportunities out there. So Number four, which is kind of a piggyback on the previous one. And, we saw a lot of this happening when values were going up, appreciation was going up. Well, the reality is most folks that we're talking to probably haven't bought their home in the last 12 months. So it seems like a lot of people that we're talking to right now about buying and selling bought, 2, 3, 4, 5, 7, 10 years ago, right? So the conversation is, well, what if my value has gone down? What are my other options here? And we circle back to an option that we talked about plenty in the past and we've had podcast episodes about, which is what if you keep your property as an investment and rent it out? I mean, first things first, then you're not only going to have no commissions or fees to sell the property, but the second is if your value or your property has devalued and you have the ability from an affordability perspective to hang on to it, chances are you wouldn't be now having to sell at a low, and rental rates are coming up. Obviously, we're huge proponents of keeping and owning real estate as it is. So something to consider. And if you really want to let go of it, then sell it when the market picks up in 2, 3, 4, 5 years. But in the meantime, continue to grow your equity. And like I just mentioned, with rental rates going up, like, I don't even know, it's not 10%, it must be like 15% right now. You can do quite well from a rental perspective if you are an owner.
Yeah, I don't have a ton more to add other than it's actually shocking how many times we speak with clients and we're like, would you like to see this option to see if it's possible to keep your property? And a lot of people just don't even think of that. Like, it just doesn't seem realistic. Whereas a lot of people, we show them that they absolutely can do that. And some clients actually don't even understand what the real benefit is. But so just to touch on that quickly, if we're in a down market, and let's say property values appreciate again in 2 years from now, there's a big wave, which there probably will be. If you own two properties in that market, you have double the appreciation. Plus, you're paying down two mortgages at the same time. And if you're cash flowing, like if you're bringing in more rent than what your costs are on the existing property, you're making some extra money every single month, right? So a lot of people, when they get into that and they have that situation, they don't want to sell that rental property because you think long term again, right? Like eventually that place is going to be paid off. You're going to have a stream of income coming in that can help retirement, and you have this massive asset that can be leveraged or sold or passed down to kids or whatever, right? So I think education on this is huge, and a lot of people come into our conversations not even thinking that it's an option.
A big piece here is with values declining to a degree. If this is a plan that you want to move forward with, you are bought in on this idea or strategy, to do it sooner than later. Like, get the refinance established sooner than later, establish the value today. Even if this is maybe 6 months away, you're thinking maybe next spring as an example to pull off, a maneuver like this, get the refinance done. You could even establish just a line of credit, a home equity line of credit based on today's value. The funds are there available to you to draw from for your down payment in the spring or in the winter or whenever you want to do this. But we've established value. We've established the balance of the mortgage or limit of the home equity line of credit today. And I think that's important because if we're expecting opportunities in the market, we should expect the value of our homes to drop to a degree. So it'd be better to get this established now than later.
Yeah, and obviously none of us know timeline. Like we had a low 2019 and then 2020 happened, right? So we could be seeing a low 2022 and then we could, by the end of a year from now or a year and a half from now, see things roaring back too, right? So, hard to say exactly, but yeah, you guys hit the nail on the head. So let's, Dean, you started the conversation on this one. We gave a little bit of a sneak peek on it, which is picking the right product right now and how you're managing it and what that looks like. So there's a lot to unpack here, but since we've done full episodes and we could probably go back to doing more updated episode on specifically that product in this environment, just generally speaking, being smart about the product you're choosing right now it's always important, but it's really it's even more magnified in a rising rate environment when property values are changing, and specifically when people are constantly making decisions based on the real estate values in this market. As a quick once over right now, we've seen interest rates increase from both fixed and variable increase from in the ones and low twos in a year from now to the fours and fives. And in addition to that, if you're looking at a lot of the economic predictions, and I mean, like, put whatever stock you want into predictions, half the time, more than half the time, they're wrong, but we could guesstimate that they have a general sense of where things are going. The sense among most economists after, the announcements with the inflation having gone down just slightly is that 12 to 24 months from now, we could be seeing rate cuts. Now, that might be a little bit aggressive. Some are calling for end of 2023 potentially, and some are saying 2024. This would obviously mean that fixed rates and variable rates would both come down within 12 to 24 months. So our thought process on that is to watch out, because you got to remember that the big banks and a lot of these online lenders and so forth are going to try to call you to lock you into fixed rates and terms and that are long out of fear as opposed to out of an analytical decision, because it makes sense for them and it puts them in a great situation. So what are you doing and how are you managing that is a big part of our conversation right now among mortgages.
Where I would touch on is obviously flexibility is always key for me. And the other example I talk about, because we've seen a lot of this, is people moving to a different town, like people moving from BC to, say, Calgary, Alberta, or a town that they just, is far away from home, let's just say that. And they don't know what to expect. It is a new job. It's a new town. It's a new everything. And what if it doesn't work out? Meaning, what if you just don't like it there? What is your play to get out of there? And so I always say, if anyone's moving to a new town or a new environment, consider the flexible option of a variable, just so you can actually exit if you have to. But on the flip side of this, like, we do have the same government in power for the next 3 years. Like, people don't realize that we just actually did an election recently. So this government is in power for the foreseeable future. And so if you have any concerns about how they're managing, the Bank of Canada and where everything is going from that perspective, if there is any sort of issues with the supply chain, if there's another war that breaks out, inflation will go right back up. So yeah, we had 1 month of inflation down, and the government's telling us they want to see 4 consecutive months of it being down before they'll stop raising rates. Not just when are rates going to go down. This is just about stopping the raise. So if we don't see that, or we see any sort of issues with this supply chain again, we should expect rates to continue to go up, especially with the government we have. I mean, whether you, like, again, this isn't about do you support the Trudeau government or not. This is just what they're telling us. And the one thing I can give them credit for is they've been pretty transparent. They've done what they said they're going to do all the way back from the pandemic when it comes to the Bank of Canada rates. They said they were going to cut them, and they did cut them, and they continue to cut them. And then they said they were going to go up, and they have gone up. So just something to keep in mind.
Yeah, just my piece on products. Those are all really good points. I think anybody, no matter what your situation is, you have to understand the products thoroughly. And that's where we come in, right? Like, we can't tell everyone take a variable or take a fix, because everyone's situation is different. Everyone's personality is different. Everyone's risk tolerance level is different. There could be someone that a variable makes so much sense for, but it's just not the product for them, because they're not going to sleep at night and they're going to be stressed and it's going to cause anxiety. So, like, you just have to really, really understand how these products work, what your worst case scenarios are. Like, if you're going into a variable but its affordability is a concern, look at a static, right? If you're going fixed but you don't like the long-term play, you can jump into a 1 year, 2 year, 3 year, right? Like, there's all these different products that people can jump into. So I think just education is so important. You kind of got to go with your gut from there, right?
Yeah, well said. And we did an entire episode on this. So if you guys didn't catch it, last episode, number 130, listen to that one where we talk about how to pick a mortgage product. Or no, it was 129. Sorry, 129, I believe. Anyways, it'll be linked below. We talked all about this fun stuff. So number 7, porting, and what does that look like? So realistically, if you don't know what a port is, it's something that I wouldn't say a lot of people use it, but it is something to consider. A port is basically when you take a mortgage from one particular property and you move it to another property. So for example, if you're selling your home and moving to another home in a different city or location, assuming that product still applies and you can qualify for it, you may be able to port that mortgage. Yeah, just really quickly on that point, the reason that we probably don't see porting that often, I mean, there's a lot of reasons. Number one, we were in a low rate environment for a number of years, so a lot of people wanted to take advantage of that. Number two, with the stress test, it's more challenging for people to qualify often for a port because they either A, want to take on more money, or maybe they just want to extend the payments or reduce the payments for a variety of reasons. But there are certain lenders that are a little bit more friendly about moving your mortgage to another property, and they have programs for that. So when we're talking to clients, we will look at that as one of the options that they could consider, seeing if it makes sense to, instead of breaking that 1.9% rate, to move over and pay 5%. Could we keep it? Could we not? Like I said, it's subjective to someone's personal circumstance, but at least something to consider or look at in this market.
I would say a port is obviously going to be a good feature for somebody that's going into a fixed rate term and wants to try to avoid penalties and be able to move that mortgage to the next property. But to your point, it's very specific situations. And I go back to the person leaving town because I'm seeing a lot of that. That is a very different situation. And that's very difficult to make a port work when you're coming back, because you mentioned it, Alex, you have to qualify. And so when you're moving back to town, there's a good chance you don't have that same job. You may be on probation with the job you're getting back in BC or what have you. So now you no longer qualify for the port, and now you are triggered a penalty. Or just let's just say, you know, maybe you're selling in a down market wherever you're leaving, and it just ultimately doesn't work to just buy a house right away. It might be like another, hey, I got to rent for a year or two. Well, the port, you only have, I believe, depending on the lender, 4 months, 3 months to 4 months, depending on the lender, to actually initiate the port. So, you know, it's just kind of down the theme of it's challenging to make it work. It is very specific situations. And I think a lot of bankers, and I don't blame them, I think it's just a poor education from the top down. They don't really realize how a port works within their own institution. And people get sold the fact that, hey, you can just port your mortgage. It's easy, but it's really not.
Port is treated like a brand new mortgage. Just for everyone listening, you have to requalify just like it's a new loan. And then if someone was porting, say, a $500,000 mortgage at 2%, but they needed a $750,000 loan, you would be getting your $500,000 at your current rate for the duration of the term left, and they would be giving you an additional $250,000 to make up the total at current rates, and they would blend that all together, and you would end up somewhere in the middle, if achievable, right? And there's a lot of reasons, like you guys already touched on a few, but you know, maybe someone wants to upsize into a house with a suite, right? And they might be with a lender currently that doesn't have a great rental program, and they need to move to a different lender to get that qualification. So there's a lot of reasons that it doesn't work. But the reason I wanted to bring up this one today is because there's a lot of people that are like, no, I don't want to sell my house. I don't want to move because I have a great rate right now. Just so you know, like there could be an option to move that over and increase, right? And you could maintain that rate and potentially avoid penalties if it makes sense.
Yeah, absolutely. These are such good points, and every situation is very unique here. So just again, this is why you want to consult and not just get Google it up or look for answers just based on the uniqueness of it. Number 8, and this is something that we're a huge advocate of, knowing that we're professionals that obviously obsess over real estate, lending, money, and more, obviously doing a freaking podcast on this stuff. We're a huge advocates of working with professionals on the real estate side. Listen, if you look on TikTok, you'd think that real estate agents are the lowest of the low, like lower than what we used to think of like car salesmen back in the day. And it's actually wild how real estate agents have been vilified in the market. And honestly, like we know and we work with hundreds of real estate agents on a monthly basis that we talk to. And 95% of them are incredible people and work very hard and care a lot about what they do. But it's actually shocking sometimes to see the type of people that are actually actively working and advising people. And so if you're someone looking to buy or sell, you make sure that you're working with someone who's not only a real estate agent, but someone who has experience and can actually educate you and to explain to you the strategy around what you're doing, why you're doing, and is connected with someone like us that can actually help them to understand that side. They shouldn't be teaching you or educating you on the mortgage market, but they should be focused on understanding at least the basics so that they can educate you. And I can't profess enough working with someone who's professional and takes it like a career. Don't just work with your Uncle Bob because he's giving you, and no offense to Uncle Bob. If Uncle Bob's an awesome realtor, then great. But don't just work with some guy because he is, obviously a family friend or something like that. And again, family friends are great. So I don't want to come off as not good, but find somebody pro, finding somebody who does this for a living, who gives a crap about your situation, who's going to update you, who's going to educate you, and take it seriously. This is a lot of money and it's a big transaction, and there's great people out there, but there's also people who probably don't deserve your business.
Yeah, I think the biggest thing is experience, right? Like, and not to knock newer agents or agents that don't do a ton of business, but you talk to someone that does 40 or 50 transactions in a year, like they are active in these markets. They see the changes, they feel the changes. They need to adapt for every single buyer and every single seller that they're working with. Whereas if you're talking to someone that's relatively new doing, 2 deals a year, sure, they could probably educate the hell out of themselves by talking with other agents, but they don't have that hands-on experience and they might not have the strategy that, the busy type agent would. So I think that's a key consideration as well, especially in a market like this.
I'll play devil's advocate to a degree, and I think that you're right in many stages. I will say that we always measure experience based on how much you're doing and the transactional experience as opposed to the years. I think there's some good questions that you can ask to find out what they're actively doing. As you mentioned, Derek, are they actively working with clients? Have they worked in this market? Do they have the ability to advise you? That's really key and important. If you're a listener of the podcast and you're looking for a recommendation for someone that we would work with in your city of choice, we're connected to people all over BC, Alberta, and even in some places outside of that as well. So just let us know and we'll be happy to make an introduction for you. So 9. Mentally prepare for worst case scenarios and removing the emotions. This is a tough one because real estate as a whole, if it's not investment, which we talk a lot about investment real estate, but real estate as a whole is a very emotional decision for a lot of people. They're doing it because they just had a child and they're looking for more space, or there was a death or a divorce, or it's a very first home, or downsizing. In so many situations, it's often attached to something extremely emotional. And for that reason, people make decisions in most cases, like quite a few cases, they make decisions that are absolutely emotionally charged and have zero bearing on what they could or should do, or theoretically what the best case scenario is. They're just, the stress levels are through the roof. We're basically glorified therapists on many days. Thoughts on preparing for that, Dean?
I mean, we talked about this during the time where people were going subject free and how to prepare for the worst case in that market. And of course, I'd be blown away if somebody's doing that nowadays. But on the flip side of that, it was just kind of what we were talking about earlier around selling before buying. Like, if you really feel that's necessary, then you just need to know what the worst case scenario is. And the worst case scenario might be selling your home for a lot less than what you expected. And that might mean that's going to disrupt the amount of money you have for a down payment. And then that could lead to, the ability to just not have the ability to close on the property that you've agreed to purchase. So, how do you prepare? I mean, family, as a support piece for extra cash if needed, if you're short. I'd say that's probably number one, is just being able to shore up extra resources when it comes to cash available if you ultimately sell for less than you're expecting. And so that just goes right back to the scenario of selling before you're buying. So, if you really do believe that's what's necessary for you, just understand the risks to that. There are some interesting products out there, and maybe this is something we can touch on down the road, but there are some vendors out there that are real estate agents that will actually agree to buy your home. That's probably a takeaway for us to bring on another guest that could speak to that directly. But there are ways to kind of mitigate this, because I know I know for a fact people just have to sell, or people have to have their home while they're moving for health reasons or what have you. So this isn't to scare you and just be like, hey, don't do this if you ultimately can't do it another way. Just reach out. There are services to help you through this, but again, just preparing for it if you're going to go down that road.
Yeah, and luckily, again, we're in a market where a lot of the risk is removed, even if you're buying before you sell, right? And I think in that scenario, if you have subject to sale, your worst case scenario is you're not selling, or you're not selling for enough and it doesn't work, right? Like, you got to kind of be okay with that, as much as obviously everyone involved, us, your realtor, you guys, you obviously want to make it happen. You just got to be aware that it might not, because of the market, and you can't let that stuff beat you up, right? There's going to be another house. It might not be meant to be, but you got to kind of have that in the back of your mind going into a market like this, right? I think this market, from a risk standpoint, is dramatically lower than the market that we were in for the last 2 years, right? It's just a different type of risk and a different type of emotion that's involved.
Yeah, well said. Well said. There's risk in every single market. It's just a matter of what type of risk. And we try to very hard to coach our clients, as we know you're going through in many situations, like an emotional experience, but here are the points at which we can remove the emotion, and here's how to do it. Let's try it. We try to be that kind of like calm amid the storm of what's going on. And that's the best way to think about it. Don't just make a jerk reaction. Let's obviously understand the situation and what the ramifications of making certain decisions are. So last but not least, interest rates, we talked about it, they're up, property values are down. How do we look at this in a different manner? How do we look at this positively? I was just reading a news article that came to our inbox that we actually subscribe to from on a monthly basis, and And specifically, he was giving the numbers here. So in Canada, the average mortgage is down, believe it or not, or house price is down by 186,000. So let me just restate that again. The average house prices are down by 186,000. Well, mortgage payments are costing approximately 10% more. Now, the interesting fact there is that a lot of people think that because rates have gone up double or triple, that rates are, their monthly payments are up double, triple. That's not the case. So remember, if you see those rates, your payments not tripling. The average payments are up about 10% more, right? But the average price are down 186. So the reality is in many circumstances, budgetary considerations haven't changed. So your cost hasn't changed dramatically. But we always talk about this. You can't change the price of the property. You can only change the mortgage rate. So we always want to think about the fact that you've paid for this property one time. Can you obviously get yourself in a situation where you could restructure your loan in 1 or 2 or 3 years? And what would that look like for you?
Yeah, and again, like there's so many unknowns in this market. I think everyone assumes that the market will come back, and I'm sure it will because historically it always does. So that's a huge consideration. And then on the flip side to that, there's also strong belief that rates will come back down, right? So we're talking about high interest rates that are likely to come back down. We're talking low purchase prices or property values that are expected to come back up. So like there's nothing but benefit in those two considerations, right? So buying right now, I think we circle back to number one, affordability. As much as the rate might not be pretty, if it's affordable for a certain length of time and you can make it work for a couple of years, again, there's unknowns, but it's very likely we're going to be back into cheaper rates. And I personally believe that when we start to see rates start to trickle down, we're going to have a massive influx of buyers again. Because like us alone, we probably have 150 people that are pre-approved and they're just sitting, waiting, right? Watching, waiting for the right time. And there's going to be a mountain of people that are jumping into this market, which is going to drive prices right back up.
The history tells us that that's exactly what would occur. Again, can we rely on history? I mean, it's hard to say just because we're dealing with different things that we probably weren't dealing with back in the late 90s and throughout the early 2000s. But what that does show us is that when we went through these rate hike cycles, it did come down. We were typically in these cycles for a 13-month period of time, and we usually saw the rates to start to fall about within 6 to 12 months after the peak of those cycles. So if that does repeat itself, then we can certainly expect a drop in rates, and obviously, to your point, more buyers, more people just considering buying, and potentially another boom in the market. And based on where we're seeing values, I mean, like values have come down. There's no doubt about that. Values have come down based on where we're at, or where we were at even just in February of this year. I mean, we've seen a lot of price points come down. So if those continue to trickle down, and then we see those the rates go down in addition to that, then we could probably see a pretty big uptick in values.
Yeah, and I think just last consideration from my end is, as much as property values are declining, we also saw like a 50% increase over the course of 24 months, right? So property values go up 50%, they're coming back down 15, 20. Like realistically, if you've been in this market for 3 to 5 years, you're still up and things are still good, right? So lots of considerations. We'll wrap it up there. So that was top 10 considerations when purchasing in this market. Again, I think a lot of these topics can be taken into consideration in any market, maybe with some minor tweaks. Thank you guys for tuning in. We're going to wrap it up here. And if you guys enjoyed the show, definitely leave us a review, and looking forward to the next one.